Okay, folks, good morning and welcome to Swing Trading Today. This is Bob Desmond, and it is 5 a.m. Eastern Standard Time, the 22nd. So I want to kick things off with the dollar. The dollar is what is driving this market right now. What you're seeing right now in this market is a deflationary trade. And the dollar has made a new, let's go to a 4-hour chart, has made a new daily high. So the trend continues to remain higher at current as a short-term trade anyway. Now we have faded here a bit. I think the key to keep in mind this week is that you're going to have Jay Powell speak not once but 3 times. The first being today for the CARES Act in front of Congress, and then finally on Thursday in front of the Senate Banking Committee. And it's going to be all ears open for any semblance, any indication of action by the Federal Reserve. We just went positive again on the dollar. So in this environment, what we'll be looking at are not the trades that have treated us well of late. And those are commodities. They're going to take a break. So it's very important to identify whether or not you're in an inflationary or deflationary period. It could be short term, could be longer term. I think longer term, we're in an inflationary period, whereas you have a lot of cash floating around out there, but the means of production is not as great as it was. Therefore, you have scarcity with a lot of money out there chasing those resources. And at some point in time, this economy is going to open back up again. And you're going to have the velocity of money, meaning the number of transactions taking place, increase, chasing those scarce products. So short-term, deflationary, no doubt about it. Longer-term, the inflation trade is still on because we have $22 trillion worth of debt rising, and there's no way we are paying it off. Jay, good morning. Sam, good morning. You got it, Jay. Larry, good morning. About something we could have a 6-month run-up in the U.S. dollar. On the daily gold, we are now below the 50-day exponential moving average. Are we close to a sell gold and buy the dollar signal? We have to keep an open mind. I wouldn't rule it out. To be closed-minded means to go bankrupt in this business. So I wouldn't rule it out. We'll take a look at let's bring up gold on a monthly chart, because the month is almost over. The quarter is almost over. And I'm trying not to act until we have every indication possible available to us where we can make an educated and informed decision. Now, when you take a look at gold on a monthly basis, and this is what we do here, high level view, you could see that we got extended a bit in July, continuation move higher in August, even more extended. What are we doing this month? We're retesting the breakout point at 1923.70. We closed slightly below that mark yesterday. I believe at current, we are flirting with that mark. Let's go to gold. It was up higher, pulled back. Yeah, we did pull back. Now we're negative. So there's a tug of war in this zone here. What we don't want to see on gold is a break to new lows and a surge in the US dollar. Because if we get that, that sets up the likelihood that this monthly breakout, which is the month of September, is almost over. Only a few trading days left to go. If we fail to hold the support level, that spells trouble for gold. So I'm willing to give it some room here, because when you take a look at gold relative to the US dollar, keep in mind, gold uptrend, breaking out, new highs, retesting support. There's rhetoric out there, but you have also people speaking their book. So do I want to hold gold at this juncture, or do I want to buy, or do I want to own the US dollar, which is putting in basically lower lows and threatening to take out, it already has taken out lower lows, lower highs and lower lows. Which do I think ultimately is going to win out here? I have to go with the current winner. You know, I may be a contrarian, but we respect the trend. So I'm going to give the dollar the respect that it deserves, in that we know that it could be a rip-your-face-off rally, as with any currency. But at current, I'm sticking with the winner, and that's gold. But that is subject to change on a dime, because life comes at you fast. Now take a look at a quarterly chart here on the price of gold. At current, we have failed to take out the highs of 1923. The ideal situation is that we close above this resistance level. And remember, gold closes out the quarter very soon as well. If we get a close above that mark, 1923.70, we'll be looking for a retest in October. And we may be talking about putting on more in terms of gold miners, assuming they break out as well, or at least hold support levels. They're not at all-time highs just yet. So I think that the jury, let's take a look at the dollar on a quarterly basis. I think the jury is still out here. Again, do I want to buy gold when I'm comparing the charts versus the dollar, when the dollar is putting in lower highs and breaking down to lower lows? Not really. I'd rather stick with the winner. The trend is your friend. But we'll watch it. You know, we're gonna we're gonna remain open-minded, and we're gonna remain nimble. Simple as that. But ideally, I would like to see, just like we wait until late in the day to identify or determine whether or not we want to add to a position, sell a position, open a position, usually opening or adding to a position in the 3 p.m. hour. I want to wait until the final days of the month and the quarter to see, are we getting bids or are we fading? And that'll give us an indication of how we're going to proceed into the new time frame, whether it be quarterly or monthly. So open-minded. Good question. All right, let's go to the pre-market. All right, gold holding support, bouncing back here a little bit. Let's go back to the dollar. Dollar gaining strength. I had to reboot, so most of my saved list here is gone. Russell, we're down just shy of a 0.25 percentage point, but we may be putting in a higher low here. Flirting with a breakout, 4-hour basis. Jury's out though. Possible higher low here on our RSI. What we care about is a continuation breakout. We have broken out on RSI. I think the area to watch, or the names to watch, are the NASDAQ 100 names. We spoke about this yesterday, and I was looking at some charts, and I figured that they were going to rally the Qs and dump the cyclicals, and that's exactly what happened. And we are up over 1/3 of a percentage point this morning. We broke out here, retested here overnight. So it looks as though we're going back to narrow breadth, mega cap names or high beta names in technology in a deflationary environment that will traditionally do well until, of course, that deflationary environment changes to concerns about inflation. And that's when we jump back into or add to commodities. Where's my S&Ps? So we're up about 1/3 of a percentage point on the NASDAQ 100. Let's take a look at what the S&Ps are doing. We're down. So it validates our opinion that they're going to rotate into. Let's clean this all up. They're going to rotate into the mega cap Q names. All right, so what we're looking for here are higher lows, and we're beginning to break out. You can't get excited about the S&P 500 until we recapture this support level, which is sloppily drawn. Let me redo this. At around 33.05. So while we're breaking out on a very short-term basis, the question is, do we recapture resistance? And right now, it's a weak market. The key is to stay solvent, keep cash, and wait for that 3 p.m. hour to see whether or not we are closing strong. We just went positive. Or do we fade? VIX futures, S&Ps are up, VIX is up. That's not good. Silver. We stopped going down in the short term. Let's see whether or not that holds. It all comes back to the dollar. Let's take a look at bonds. We'll go with the 10-year. We're up, which means that yields are slightly down. That bodes well for tech, as we're seeing evident this morning. Oil's had a nice rally back this morning. We're back above $48 a barrel on light sweet crude. That's a big rally back. Let's check out the euro. One of the reasons why we have the dollar surging right now is the resurgence of COVID in Europe. And this is not a pretty chart. We have a breakdown on 4-hour basis. Lower highs and lower lows. All right, so this is a sloppy chart. It's weakening. And the euro makes up 55% of the Dixie dollar basket of currencies. Let's check out the yen, which is the second largest component of the Dixie basket. Actually, third largest component of the Dixie basket. Potential lower high here. Jury's out. Trend is still up. Weekly view of the yen still looks positive. Fade last week was not positive. Well, actually, this is a daily chart. Click the wrong button. We do have a new weekly high on yen, but it faded. It's early in the week. We'll see what happens. Back to a 4-hour chart. We're spending a lot of time on the dollar, folks. And for those folks just joining in, it's all about the dollar. Have no doubt about it. It's all about the dollar. It's influencing sector rotation. Okay, let's take some chart requests. Lagarde will do something for the Euro USD. Well, she's probably going to want to weaken it, right? Euro versus USD, because their exports become cheaper. Yep. Before we go into chart requests, let's talk about. We have a bunch of Fed heads today. Jay Powell testifies on the CARES Act. Tomorrow, more Fed heads. We have PMI, Purchasing Managers Index. Lots of Fed heads out this week, stirring up the pot. Thursday, initial jobless claims. Oh, he's in front of Congress twice for the CARES Act this week. Look at all these Fed heads. The life they must have just giving speeches. All right, Friday we have durable goods orders. That's very, very important. For those folks not familiar with durable goods, those are your washing machines, dryers, appliances that last several years. Refrigerators, etc. This should be a hot number. Given the surge in housing prices and transactions nationwide as people flee the cities and take advantage of low interest rates. So I expect the durable goods numbers should be pretty hot. All right, let's go to some chart requests. First up, JAAPL. Okay. Monthly chart, we found support yesterday at 109.67. We just managed to barely close above that mark yesterday. This is a weekly chart, and I warned the other day when I drew this head and shoulders setup that we may see weakness, and sure enough, we got it. Daily chart. Despite the fact that you saw XLK rally back and close strong yesterday at the highs of the day, Apple did not. It faded. So while I like tech in this environment short term anyway, I don't like the close here on Apple, despite the fact that we closed off the lows of the day. So unless we recapture 109.67 and close there, we could pull back to 101.48, which is the next support level below, or even below that. Either here, sometimes they just fill the gap in a prior high at 99.22. That brings us back down below 100. Or for a worst case, $97 per share on an extreme filling of the gap. We'll leave it here for now. We're heading into a seasonably favorable. You know what? This is only 5 years worth of data. Not enough. Let's go all the way back. Still, going back 36 years, October is a very strong period for Apple, whereas September is not, and that makes sense this year again. So seasonality looks very, very good here for Apple, but in terms of technicals, it's not quite there yet. You saw a fade yesterday. That has me a bit concerned. So I would buy strength, a close above, let's call it 110 per share, on a pullback to one of these support levels down here at, let's call it $100 a share. Now Zoom was the stock I saw early on yesterday, which was up for the most part all day. I said, that's what they're going to do. They're going back to the COVID plays. They're going back to tech. Forget the monthly chart, not enough data. A new weekly high. More room to run here. We are very close to the all-time high at around $4.79 per share. Where do we close out? We don't have much upside here to open up a trade. If I were long, I'd stay long. But I would like it more on a close and a retest above $4.79 per share. I mean, the indicators look very, very good here. So it's a really nice chart. I doubt there's enough data here. Yeah, forget seasonality. 4-hour chart. I think we'll probably head up higher today. Looks good. We closed right at the highs of the day yesterday. Zoom looking good. UNG. UNG is a commodity play, but it's not as inversely correlated to the US dollar as is oil or gold. Just goes to show you that what looks so promising on a monthly time frame only a couple of short weeks ago here when we broke out can fall apart really quick. But is this that bad? I don't think so. I think what we're doing here is we had broken out in August. We're pulling back and retesting. So long as we hold this support level here, what's the low? We'll go with the low. Low of 1128 on UNG. We're good. I'm viewing this as a breakout and a retest. Our indicators are looking good, putting in higher lows now and higher highs. Same deal here on RSI. Let's take a look at the seasonality factor. How much data do we have? Let's go back. This goes back to 2007. Seasonally, not a wonderful period of time. Typically, you want to start looking at nat gas in February because it tends to rally through April, I should say. Sorry about that. I meant April. So seasonally not wonderful. But we're looking for a breakout here. When you're looking for a breakout, a continuation move higher in a monthly chart, a year could fly by in a heartbeat in terms of a consolidation, base building. So I wouldn't read too much into this or have an urgency to go getting long at current. Unless, of course, the lower time frames, weekly or daily, changes our mind. And the weekly time frame is actually looking pretty good here. Higher lows at current, subject to change. We want to see a close at the highs of the week. Let's see what we're doing on a daily basis. The trend is still down here. I don't see a compelling reason to go buying. We did break out yesterday. We need to see a pullback, and let's see whether or not this holds. I'm not loving the seasonality at current. I don't see a reason to go buying in the middle of this. If you look at the upper band here and the lower band here, we're in a triangle formation. We have a volume shelf right above, which to me, I interpret that as being resistance. So I don't see a compelling reason to go buying UNG at current. Would I be shocked if it moved up higher? No. But from a risk-reward entry point, would I pull the trigger here, either long or short? No. And to a lesser extent, to the short side, I would not short it. Let's take a look at the members area. GRAF. Let's see how we did yesterday. All right, Graph Industries broke support. This is a daily chart. Let's go to a weekly chart. Currently, we're trading down below 24.36. We have lower highs on RSI. Let's go to a daily chart. Yeah, support broken. Stokes are very weak here, trading down below the 50 mark now. We know that if we get a rallied, there's a tendency for those rallies to fade. When you have Stokes declining down below 50, I would avoid this trade to the long side, and if anything, it could be a short. I would avoid. LAC, Lithium Americas, very extended still on a monthly basis relative to the third standard deviation Bollinger Band. We know that the last time we saw that back here, it did not end well. And it usually doesn't. Very extended. We're holding support at current. The froth of last week relative to the third standard deviation Bollinger Band has come off. But the monthly pressure remains on. Daily chart. I think we need to see a retest of support at $9.68. If we get a bullish reversal off of that mark, there may be a long trade here, but that monthly time frame, the monthly chart, has me leaning against opening up a new trade here because that froth has to come off at some point in time. JNUG. A lot of damage here this week. You know what? I'm just going to go to the GDXJ. Same chart. Chart's a bit cleaner, though, when you use GDXJ versus JNUG because of the volatility and the reverse splits and this and that. All right, so monthly time frame, you know, we had broken out last month on the GDXJ. This month, breakout point failure. We need to do some serious rallying back here. Weekly chart. We have broken support. $55.05 critical support for JNUG. Excuse me, GDXJ. Critical support. So no, I would not, whether it be JNUG, whether it be GDX, whether it be GDXJ, whether it be NUGT, I would not go opening up or adding to gold mining trades right now. Way too much risk, not enough reward. Let's check out the seasonality here. How much data do we have? Enough. 11 years. September, traditionally a horrible month. You know, these next several months, it's not a wonderful period of time for the miners. It begins to pick up in January, flounders a bit in February, March. April is the Pimp Mac Daddy. Actually, no, August is the Pimp Mac Daddy month. Then April. So let's keep this in mind. Seasonality, not necessarily favorable this period of time. All right, with that, folks, I'm going to say, everybody, please have a profitable trading day. Please smash that like button, follow if you would. I'd really appreciate that. And stay safe, no impulse buying. Wait for that 3 p.m. hour. Let's see whether or not, if we do get a rally today, if it fades, or do we close strong? And pay attention to what sectors close strong. My guess is we're going back to tech, as we saw yesterday. So keep an eye on it, and everybody have a great day. Be well.